All right, so let's talk about taxes on his payout from a private equity firm that's going to come to him over 36 months, $1.5 million net. Let's just say it's a couple $1,000,000 paid over 36 months. It's going to blow him up. What does he do? Let's start right now. You got hi, Joe, Alan, Andy. Absolutely love your podcast and look forward to every weekly episode. Originally started listening to one of the other retirement podcasts, which will remain nameless, which helped me understand the basics, but soon felt too simplistic. After a while, felt like continuing to ride a bike with training wheels. Oh,
yeah, too basic.
Yeah, take those off. Plus, it was a little too touchy-feely about feelings related to retirement. And that got out pretty fast.
Well, now I know which one it is.
I could not listen to like 30 seconds of that.
The touchy-feely?
Oh.
You know, it's
you and lighter side.
You and I have done this where you go to workshops and then they want to meet in small groups and discuss something. Like, how do you feel about retirement?
Tell me how you really feel. No, how do you really feel?
And then you and I decide we've picked that spot to go to the bathroom.
Yes.
Sorry, really got to go.
Yeah, Alan and I got a really small group. And we're going to talk about how much we hate this. I don't know who this is, but I guess Andy
knows.
Andy knows. All right. A little touchy-feely. We don't get touchy-feely here. We get flippant.
And snarky.
And snarky. And arrogant.
Yeah, sarcastic.
It's like, understand your numbers, people. Jeez. Instead of, what are you going to do when you wake up in retirement?
Yeah, that's not our show, is it?
No, it's not. I can see why I got pretty old. Well, welcome to the club here, sir. I need a little more substance than finding you guys. Holy crap. If the prior podcast was a primer, your podcast is like a graduate education.
Wow.
I've learned so much, even when questions don't seem to apply to my situation. Joe, what really impresses me is that you can read a very detailed email question from a listener that includes way too much information. And let's be honest, it's obvious that you are seeing the email for the first time when you read it.
No kidding.
No kidding. All right. So you do like the show. And you can distill it down to essential question before being asked. It's like you have some kind of magic filter and can get to the basic issues. So that is probably your superpower.
So I agree with that. You are great at that.
Oh, well, thank you, Al. Really
Do you think that's your superpower, Joe?
I don't know. No, I don't think so. I don't even understand what he's trying to. Well, because there's a lot of fluff, and I probably know where the question's going.
You get all these numbers and comments, and you go right to the meat.
Got it.
That's one. That's not your only. That's one of your superpowers.
Right. Anyway, I have a simple question, though I feel guilty for asking it. I work for a private company, not publicly traded. We have an option of being a part owner, and I have a number of shares of the company. The shares themselves are not particularly valuable, but we are in an industry in which equity investors have an interest. There's a new equity investment deal every 5 or so years, so there is a new influx in cash to our company, and as a part owner, I stand to profit next time there's an equity event. Oh, a little private equity.
Yeah, I like it.
So private equity is buying, and so they flip every 5 years, it sounds like.
Yeah.
My wife and I are 62, hoping to retire at 65. We have approximately $2 million in a variety of 401k, brokerage accounts, and old SEP IRAs. We do not yet have any Roth accounts, but hope to start converting soon. I would estimate our gross income to be about $225,000 per year. We have 3 children, 2 still in college, but college expenses are covered by prior 529 plan savings. We have about $100,000 balance on our mortgage with about $500,000 in equity in our house. Really no other debt to speak of. My question is this. It is likely there will be a company equity event in the next year. It will probably net me around $1.5 million or more. Oh, congrats. It will likely be paid out in increments annually over 36 months. Then I retire and go fishing every day. I was thinking about a little touchy-feely moment there.
Maybe it's not bad.
I thought
And he
better.
stamped it out.
I know this is an unusual windfall situation, but I'm wondering what the hell will this do to my tax situation? Well, you already said it's net 1.5.
Right.
So he's already calculated some sort of tax. This will likely push me into the highest tax bracket over the 3 years in which my income will look particularly high. Are there any mitigation strategies I can consider to lower my tax burden over those 3 years? I do not think my company offers any kind of deferred comp, which would allow me to spread it out over several years. Any help you can give would be appreciated. By the way, I drive a 2019 Tesla Model 3. It costs me around $50 a month to charge compared to my wife's $80 per week SUV. Have a recently neutered 1-year-old yellow lab, and I prefer a nice Cabernet for my drink of choice. A little cab guy, huh?
Sure.
Thanks for all you do and for the excellent information you provide. I learn something new every week. I recommend your podcast to all my friends and family. I've never seen your videos, but I listen to your podcast in my car. I picture Al looks like Bill Nye the Science Guy.
Oh, you think I look like Bill Nye?
No, I think you look like Tom Schmidt.
Mike Schmidt
Mike Schmidt. Yeah,
Yeah,
there it is. Mike
on the
Schmidt.
Phillies.
Yes.
Third baseman.
And Joe looks like a young John Madden.
And I don't think you look like John Madden.
John Madden's like 700 pounds.
Well,
Even
he
when he-
probably wasn't when he was young.
No, he was
He was
big, younger.
always big.
Oh, okay.
Andy is a wild card. Maybe it looks like Tina Fey.
Oh, spot on.
Wow.
Got that one.
Really? Wow. Okay. I'll
I
take
can
it.
look it up, but I'm a little lazy and prefer to keep the images in my head anyway. Keep up the excellent work. So little Bill Nye, the Science Guy, and Johnny
Yeah.
Madden.
I don't think I've ever worn a bow tie
Well, I
in my
think
life.
you are very Bill Nye like,
You think?
and I
huh?
guess I could be John Madden like.
Yeah, just the way you talk.
Sure.
Well, he's going entirely based on our voices.
Yeah.
Right.
Okay.
Yeah.
You know.
I'll accept that.
Okay.
Yeah, you accept John Madden.
Yeah, you're like kind of like if you were a TV show, you would be like the Lifetime channel.
Are you
The
saying he
lifetime.
is the touchy-feely side of retirement?
Yeah, I'd be more touchy feely, and
Right,
plus everyone would have a happy ending.
Yes. No,
There's no shooting,
Yeah.
no conflict.
Yeah.
Well, maybe a little conflict, but it all gets resolved.
Yeah. I'd be more like Cinemax.
Got it.
All right. So let's talk about taxes on his payout from a private equity firm that's going to come to him over 36 months, $1.5 million net. Well, let's just say it's a couple $1,000,000 paid over 36 months. It's going
Yeah.
to blow him up. What does he do?
I'm going to say that net means net after closing costs on the deal instead of net of tax.
Sure.
But so I'm going to assume it's $1.5 million, gets that over 36 months. So I guess the first thing is this is capital gain. It's not ordinary income. So regardless of your ordinary income amount, capital gains sit on top of that. Capital gains get taxed at either 0, 15%, or 20%. So based upon $225,000 a year of salary, and let's just say you get $500,000 over the next 3 years. So that will put you into a point where some of the capital gain will be taxed at 15%, but some at 20%. So there's a 5% delta if you could spread it around a little bit more evenly. And then also, I'm not really clear. You say it's your company, or are you investing in it? If it's your company, if you're actively involved, if that's where your salary comes from, then you don't have to worry about that net investment income tax, which is another 3.8% tax on top of the 15 or 20. If this is an investment, then you do have that tax. So actually it would be more like 19% and 24% versus 15 and 18, roughly like that. But here's a thought I have, which is depending upon when the deal closes, maybe you only have half a year where you get half of it, and then you have 2 years of full, and then another year of half. So it may not be quite as bad as you think. For the reason that it may be spread out more than you think, maybe kind of straddle 4 years instead of 3, and it's capital gain, which is a lot better than ordinary income rates.
So straddle is what you're saying.
I like straddle.
Okay, straddle.
Yep.
Straddle the payments to get over 4 years versus 3.
Yeah, and I think that will probably happen unless it closes like right at year end.
January
Yeah,
1st or
yeah,
again.
yeah.
December 31st.
Yeah, right.
Well, I guess some strategies that you can look at to reduce capital gains tax is that a capital loss will offset a capital gain dollar for dollar. So if you have a brokerage account that is not a retirement account, which I believe he does, and if you have losses within that account, you would want to sell those and buy something similar to capture those capital losses, which would offset the gain.
Yeah. Here's another one. This is kind of out there.
Okay.
But you could
Put it in a CRUD.
Yeah, if your company allows it, you could put it into a charitable remainder trust. And then when it's sold, then that money will flow into the trust. There's no tax to be paid because it's a tax exempt trust. You will receive a lifetime earning stream. Yes, that will be taxable, but at least you don't pay all the tax up front.
Are you prepared for retirement? Schedule a free financial assessment with an experienced financial professional right online at purefinancial.com.